Top 5 dividend stocks to buy in 2023. Welcome back to another Stock Dads video. This is a channel where we talk about stock picks, due diligence, and how to invest the right way. Dividends are cash payments that you get for holding shares of a stock or index fund, which is made up of many different stocks. Now, obviously that sounds great, but there are many dividend stocks that are actually traps and will cause you to lose money, while others are very good for both short-term and long-term passive income. With this video, we're gonna break down those top 5 dividend stocks by categories. Make sure to smash the like button and let's get started. Stock number 1 is actually a ETF and is going to be the JEPI, JP Morgan Premium Income ETF. This is a $55 stock here as of this recording, which pays about 11.7% dividend yield. Now, this one in particular is a super popular stock because it pays monthly dividends. So that 11.7 is the annual dividend yield, which is approximately how much it adds up to on an annual basis. But you divide that by 12 and roughly that's the amount you're going to get every month. With this particular ETF, it's made up of a basket of many different stocks chosen by money managers that have tens of years of experience in the field from JP Morgan. So JEPI incorporates covered calls to create income every single month. So what it does is that it writes call options on the shares that it owns. Let's say you own 1,000 shares, right? You can sell 10 covered calls to someone and generate passive income by collecting that premium from that person. Over the past year, JEPI has actually had a negative 10% return when it comes to the share price, but that's not including the dividend, which has been over 10% over the past year. So it has generated a positive return. And year to date, it's approximately flat. Many high yield stocks are very risky because they have an income that is trending negatively. The share price has also been trending negatively. And as a result, they have a risk of cutting that dividend. In this case, the way that they generate income is totally unrelated actually to the underlying fundamentals of those companies. It's just a way that they generate income by using options. And you always want to be wary of what the expense ratio is for ETFs because those fees could cut down on your gains. Luckily with JEPI, the expense ratio is about 0.35, so definitely not a deal breaker by any means. That's actually pretty low for an ETF. By the way, if you're liking this content so far, make sure to subscribe to this channel so you don't miss the next video and comment down below what's your favorite high yield dividend stock. Moving on to number 2 is the SCHWAB US Equity Dividend ETF, otherwise known as SHIELD, I call it. SCHD is the ticker. $73 per share as of this recording. If you look at the performance of dividend stocks, by the way, through the bear market and many other recessionary periods, they actually hold up very well compared to growth stocks. This one is again, barely down over the past year and a half, despite the bear market. What I really like about the SCHWAB US Dividend ETF is that it is made up of many blue chip, big corporations with strong dividends and share price growth. And you can see that reflected in SCHWAB ETF. So it has a 3.5% dividend yield, and it's also gone up over 50% in the past 5 years. That's not including the dividends. So if you took those dividends and reinvested into more shares, you would get a bigger and bigger return over time. And this does have a very strong long-term track record, right? Beyond the past 5 years, if you look at the max history here since 2011 when this was created, the all-time performance here is 188% return on your investment. Again, not including those dividends. What makes this a great long-term candidate as well is that it has an even lower expense ratio than we saw with JEPI and many other ETFs. This only has a 0.06% expense ratio. Some of the top holdings in this ETF include ABBV, MARK, so AbbVie, Merck, Pepsi, PEP, CVX, Chevron, a lot of healthcare companies, some consumer staples, communications with Verizon, UPS, Costco, and many of those stocks are dividend aristocrats, meaning they've been paying and increasing that dividend consistently year after year for the past 25 years. Let's turn our attention to some individual stocks with number 3, the monthly dividend stock, and that is O. O is a $60 stock here as of this recording with a 5% dividend yield. This is one of the highest yields it's had over the past couple of years. This stock consistently increases its dividend because as a real estate investment trust, it is designed and required by law because of the way it's set up to return most of its income to shareholders. To give you an example of some of O stock's tenants, they include Dollar General, Walgreens, 7-Eleven, Dollar Tree, Wynn Resorts, FedEx, etc. So a lot of essential businesses within that in many different industries. O is a dividend aristocrat, meaning it's been increasing its dividend for the past 25 years. It's been on the market for about 28 years on the public stock exchange. So pretty much since the beginning, it's been increasing that dividend. So this is definitely a experienced real estate empire here, buying more properties and renting them out to generate more income. So you don't have to buy your own real estate. You could buy O stock. Just to pop off some more stats for you here, over the long term, O has increased its dividend by a compound annual growth rate of 4.4%, 101 consecutive quarterly increases, 632 consecutive monthly dividends paid for 54 years. But what really struck me here is that if you reinvested those dividends in O stock, over time, you would have actually outperformed all of the major indices in the stock market. That $100 would have grown to about $4,000. Compare that to the Dow Jones, other real estate investment trusts, S&P 500, and the NASDAQ. I thought the NASDAQ would have been the one to beat them all, right? But it's actually O stock here by a wide margin. Let's put that into a different context. Basically, if you invested $100 in O stock in 1994, you would have almost 40x'd your money. Moving on to stock number 4 is Charles Schwab stock, one of my largest positions in my investment portfolio right now. I think Schwab is hugely undervalued. This is one of the top investment services company in America. It has almost a $90 billion valuation here, but down over 35% year to date because of the whole banking crisis. A lot of people are concerned about two things. Number one is that Charles Schwab has some unrealized losses on its bond balance sheet. However, there is no danger of this company having to sell its bonds like Silicon Valley Bank and having to take that big loss. This company has been posting record revenue and record net income over the past year, so I don't think that this is a problem for shareholders. Net income was up almost 25% last year, so the fact that it could be doing even better is just a good thing for the future. Now, the other thing is that people are thinking that Charles Schwab, as an investment services company with $7.3 trillion in client assets, most of those in brokerage accounts, people might think that they're going to pull money from brokerage accounts into money market funds or just somewhere where people can get a better interest rate instead of the cash sweep program that Charles Schwab by default puts those uninvested cash into. That behavior is not expected to rapidly change, and it's actually expected to moderate over the course of this year. And if the stock market keeps going up and recovers, then I think people will definitely want to keep money in their brokerage accounts. The other thing about Charles Schwab and why it's undervalued is that it's currently trading around a PE ratio of 15. And if you look at the long-term trajectory of their PE ratios, the average over the past 5 years is actually 22.7. So it's almost a 50% increase from the current valuation. Also, they've been increasing that dividend over time as well. Just recently, since the beginning of this year, they increased their dividend by about 25%. It currently yields a 2% for the valuation, and also that they have been increasing that dividend makes it one of the top undervalued stocks right now. I think that's the case, and insiders think that's the case too, because if you look at the past couple of weeks, insiders like the CEO have bought millions of dollars worth of shares. So they're putting, their money where their mouth is. And hopefully by the time this video comes out, Charles Schwab is actually going to be reporting their earnings on April 17th, but we'll see. Comment down below if I was right. And lastly, stock number 5 is going to be JFIN stock. So this is what I call a wild card or a new dividend stock, because JFIN only recently introduced a biannual dividend, and total is going to return a minimum of 15% of annual income produced in the previous year. So in 2022, JFIN reported about $115 million worth of net income on a USD basis. This is a Chinese company with the current market cap of around $200 million. That works out to over a 12% dividend yield. Now, some people might think that a 12% yield, like I talked about earlier, some of these high yield stocks could be risky investments. However, looking at the financials, this company reported over 80% revenue growth and over 150% net income growth in the past year. This was not an easy year in China. This is a fintech company that does lending. Over the past year, China only just recently started to reopen its economy. Just goes to show you that it is getting market share. There is a market for its services. And if it continues to grow, that net income and that dividend is going to continue to grow as well. The share price growth here also has some really high potential because this company only trades at a PE ratio of 1. Not to mention that they also have a share buyback program going on right now. A fast growing company with an extremely low PE ratio. And if you look at some of its peers like JFIN, like FinV, a couple of other lending companies, the lowest PE ratios that I'm going to find for other companies are 3, 4, 5. So you're seeing potentially a stock price of around $10 per share instead of the current price right now. All right guys, so those are my top 5 dividend stocks to buy right now. So you have JEPI for the best high yield dividend, SCHD for the best long-term index fund, O for the best monthly dividend stock, 4 is going to be SCHWAB stock for the best undervalued stock here, and number 5, JFIN for the best new or wildcard dividend stock. If you like these stock picks, make sure to give this video a big like. Check out the description for a link to our Discord premium membership. This is where we give our live trading alerts, live streams, video courses, and much more. See you in the next video and good luck investing.